Good morning, everyone. Welcome to this update for global stocks and commodities for the 3rd of September. This is going to be a quicker version this morning because I'm traveling this weekend. But importantly, the US jobs report was out overnight, and everyone was looking at that to figure out what the Fed was going to do about interest rates. Would they raise in September or would they hold off longer? And as it turned out, the jobs report came in a little bit weaker than what was expected, but not so weak as to cause any fears about the economy. So again, it was pretty much a perfect Goldilocks kind of report where the Fed is likely to continue to just sit and do nothing, which of course the market loved. So let's have a quick look through what transpired during the week and particularly overnight. The S&P bounced around a bit last week and ended up higher by 10 points overall, but did manage some of that recovery during the Friday night session. And it's been now 7 weeks within a very tight 30-point range, which is pretty unusual. However, there is a bit of a slight bullish bias to the action, which leads me to believe that the next move will be higher. It's also supported by the fact that we paused for nearly 2 years and now we've broken out and haven't gone back and retested the initial breakout zone, and also by the fact that we're seeing a rotation into the more aggressive areas of the market, technology and consumer staples into consumer discretionary, and it's not huge, but it is definitely there, and you'd have to say that the market has a more bullish bias than the other way. However, that's the big picture. Having said all that, September is traditionally the weakest time of the year. So some seasonal weakness is still possible. So just be mindful about your discipline, and I wouldn't be making any major moves at this time of the year. The Aussie stocks, the dollar was roughly steady at 75.7. Jumped around a fair bit with other currency moves, particularly with the yen and the US dollar, but ended up the week where it started. The S&P index was down by a very nasty 142 points on the week. Now we'll see a bit of a rebound on Monday, but commodity stocks and banks heavily under pressure, and that's why our index was down by so much on the week, and the underperformance of our market just continues in quite significant fashion compared to the US. Reporting season in Australia has finished, and we saw a lot of very wild swings in prices, and a lot more negative swings than positive. There were some stocks that went up on their reporting announcements, but by far the majority went down. And this is really a consequence of one of the problems that we've had with the Australian market for the last 3 or 4 years, and one of the reasons that I started trading and investing personally in America about 4 years ago is the fact that because our market is relatively small, because we don't have a large number of really high quality growth stocks, that the ones that we do have are just priced for perfection all the time. And so if there's any little miss at all, and it can only be really sometimes very minor, as we saw with some stocks, they just get absolutely slammed. So opportunities do remain in the Australian market. There's no question about that. However, there aren't that many of them. They're fairly easy to identify in terms of what the companies are, but the harder part is having the patience to wait for the inevitable price dip, which will always come along. You might have to wait quite a period of time, but it will always eventually come along, and that's the difficult bit, trying to identify those entries. And so this is the reason why trading overseas is so attractive to my mind. Let's take a look at some charts. We'll start with the S&P, and let's just get a big picture grab. So 5 years up, 2 years sideways in a big consolidation, a couple of minor breaks, looked like we were dropping into a bear market, but very quickly the market regathered itself, and we've now broken out. And we've been broken out now for such a period of time without retracing the breakout zone at 2130 that you just have to conclude that this is the start of a new bull market phase. Even though fundamental considerations, you may not feel too comfortable with that, the fact is this is what the market is doing. And you can see there's a little bit of a mild bullish bias there. There's just a little bit of an uptrending bias to the price action, and I think the next move is almost certainly going to be to the upside, I would expect. Turning now to the Australian market, there's the Australian index, excuse me, over the week, got up to this 5600 resistance level, and it was just all downhill during the week. Fairly nasty week. So definitely underperformance in the Australian market. Turning now to, importantly, precious metals. Gold certainly dipped during the week when the US dollar went up in expectations of what the Fed might do. But the US dollar slipped again on Friday night, and that pushed gold higher by $4 on the week. It was about $20 odd on the actual session itself, but net $4 for the week. Plenty of volatility around the currency moves. Now, silver was strongly higher. It got down to the 50% retracement level, which held and then has rallied back to its breakdown. And it had quite a strong session overnight, as we'll see. Now, my only consideration, whilst there's been some pretty impressive looking reversals on Thursday and Friday night in precious metals in the States, my only consideration is that normally any sort of correction, be it precious metals or any other kind of market, will normally run for between 3 to 6 weeks, particularly if it comes after there's been such a significant rally as we had in precious metals. And you just have to think about the psychology of the market to know that that's true. Because when there's been a huge run up in price and a lot of profit on the table, and the market starts pulling back sharply, as the precious metals market did, we had a 10% down session the Wednesday before last, and that's a huge move. Then when that happens, some people sell out straight away, and some people sell out after a few days, and others take several weeks to sell out. And that's why a correction normally takes that sort of period of time. And if you look back in history on all the bull markets since 1980 in gold, then the stock indices have given back between 27 and 54% of their prior gains. Now, at the moment, we've only been, depending on where you measure this from, we've only been in correction mode for about 2 weeks, and we've only given back about 25% of the gains. So we are still really not where you would expect to be in either price and time in the correction. So that's why I just remain a little bit cautious, because that hasn't played out in the normal way that you would expect psychology would dictate. However, you can look at it the other way and say that this was also the strongest first leg higher in precious metals in history in any bull market. We're also now into the strongest seasonal part of the year for precious metals. The buying in India and China is starting to kick back in. And of course, we've got this very big picture backdrop, which is what central banks have done to the world's financial system with negative interest rates, and all the quantitative easing has just completely distorted everything, and therefore is influencing more and more people to go back to something tangible such as gold rather than paper currency. So I wouldn't say that the correction is not finished and it's all upwards from here, but I'm still just a little bit cautious on that. Let's take a look at precious metals. So we'll start with silver, and you can see quite a decent move in silver overnight and rallied back to that breakdown level. So this support and resistance level there was a really important long-term. You can see I'm way back here now to 2004. So this was a really important support and resistance level. We managed to break decisively above it in July. We came back, we tested it again, then we broke through it. We've come down to this 50% retracement, so 50% of the run higher from June, and then of quite a strong recovery last night. Now it's Labor Day holiday in America on Monday, so we'll be able to see how precious metals trade in Europe and in Asia on Monday and Tuesday before the American market reopens. This was gold, not quite as impressive, but nevertheless still continues to hold within that consolidation. Now let's just look at the GDX index. So you can see here that we had we didn't quite get down to the 38.2% retracement, which would have been around about 24.3 on the GDX. We got down to a low about $2, sorry, about $1 above that. Quite a nice reversal on Thursday, as you can see. That's a very solid upward candle and accompanied by some good volume. And then, of course, we got a gap higher last night because the jobs report came out before the market opened. And so we got a gap higher, traded up a little bit, down a little bit, and ended up where it started. So that was a little bit inconclusive in terms of that finish. So keen to see what the next couple of days brings in Asian and European trading. Other commodities, copper was steady at 209. Crude oil went down on the week, but did improve a bit on Friday night. But it had been sold off earlier in the week quite sharply, and again, that was with the US dollar going up. So, look, same comments as last week. It's consolidating a base, I believe, in crude oil. We've got resistance at 50. I don't know when that'll break, whether it will break this year or whether it'll be sometime into next year when the market is starting to move back into more of a balance between supply and demand. But as most of you would know, commodity stocks will tend to lead the underlying commodity. So we're going to see energy stocks start to move well before the price of oil breaks back through $50, I believe. It's possible that started, but I think it's still too early to say. So be pretty careful in that space. So just to wrap it up, it's highly likely, as I said last week, that we've got multiple new bull markets underway. That's at a big picture level. We're seeing definitely a focus from yield stocks to more growth stocks. We're seeing a switch from safety to risk on. So the signs are pretty clear to me. Just be aware of the short-term seasonal weakness. September, if the market is going to crack a little bit, this will be the month that'll do it. So just be aware of that short-term seasonal weakness. And when it comes to precious metals, it's a bit tricky at the moment. I'd feel much more comfortable in a couple of weeks' time because the correction would have played out in a more normal fashion that I would expect based on human psychology. And ultimately, that's what moves markets in the shorter to medium term. It's all about human psychology and expectations. Markets move in the longer term based on fundamentals. But in the time frame that most people trade, it's a lot more about psychology. So tricky period. Don't make any big moves either way, and let's see how it plays out. There's my contact details for anyone that would like to get in touch with me. Very exciting time. I'm as I said a few weeks ago, I'm as bullish as I've ever been within the context of just managing trades and managing the volatility. But a period of very exciting opportunities. That's it for this week. Cheers.